So hello from Marrakesh, where it's a lovely morning before the noon and afternoon heat comes in. We're here today to talk about a report, Less is More. Fewer reports would improve the IMF's global surveillance. And this is a paper that's being presented in the context of the Atlantic Council's Bretton Woods 2.0 program. And I'm here with the author, Tamim Bayoumi. Tamim Bayoumi is currently a visiting professor at King's College in London. Tam, you retired as an IMF deputy department director in 2020 after a long career. You worked on the countries of Japan, the United States, Canada, among others, and of course in the research and strategy departments of the IMF. Perhaps most relevant for our discussion today, Tam was leading the team that produces the World Economic Outlook in the early 2000s, and of course he has a lot to tell us from his inside knowledge of how that report actually is being put together. Moreover, Tam, you've written a book, an excellent history of the global financial crisis, titled Unfinished Business, the Unexplored Causes of the Financial Crisis and its the Lessons Yet to be Learned. It's available from Yale University Press. So, Tam, let's go straight into the topic. Maybe you should explain to our viewers what actually is fund surveillance. How does it deal with it? What are your kind of key approaches?
Well, I start the paper by using a quote from Mike Musa, who was at that time the senior economist, the chief economist of the fund, and he said, the job of the fund is to manage crises, and we've managed to have a lot of them. Now, Mike loved quips and things like that, and he liked this one. But the point is it encompasses two sides of what the IMF does. The first is that we manage crises. So, we lend to Greece during the Euro crisis, and we lend to Argentina and Ecuador more recently. And we've managed to have a lot of them, or rather, hopefully not have a lot of them, is the other half, and that's surveillance. So the IMF takes a view of the world economy and says, what are the risks, and then makes policy advice to say, well, how can we avoid those risks? And that's surveillance. And in particular, this paper focuses on global surveillance, where the fund takes a view about the global economy.
Now, the title of your paper is There Are Too Many Reports. So why do you think that there are too many reports, if it's so important?
Well, the IMF's global surveillance comprises 4 separate publications. And, it's a bit of a sort of cubist approach, where you have actually 4 publications, both talking about the world economy from different points of view. And look, I like cubist paintings, but I often find it difficult to work out exactly what a cubist painting is about. And I think it's the same with this. If you made it a single report with a single perspective, it'd be much easier to distill what the fund actually thinks about the world economy and what its policy advice is. So the essence of the paper is that. Let's simplify and have a single report.
Maybe also step back a little bit. I mean, we know that the IMF is producing a lot of country papers. I mean, people have come across a country report on Argentina or the US. But you're talking, of course, about global surveillance. So how is this organized? Why is there kind of 2 different strands of surveillance reports, as we're being called?
Well, in addition to the country reports, the IMF realized at some point that it was necessary to look at the global economy because of the interactions. What's happened over time is that as the global economy has become more complicated, we've got more reports. So it started out when I was running the World Economic Outlook report. That was the only publication, and it summarized the fund's views from a macroeconomic point of view. After the Asia crisis, there was a decision made that there needed to be more focus on financial issues. And so they created a new department, and out of that new department, they started producing something called the Global Financial Stability Report, which obviously looks at financial issues. Subsequently, they also launched a fiscal monitor, which looks at underlying fiscal positions and analyzes those. And then finally, most recently, there's the External Stability Report, which looks at deficits and surpluses across countries and discusses those. Now, all of these reports have the same basic format, which is that there's an initial chapter discussing the current conjuncture and the policy advice and the risks. And then there are research papers attached to them as well, policy relevant research. And interesting enough, after the 2008 crisis, when it became clear that financial and macro were pretty much joined at the hip, they didn't change the underlying structure. They got the groups to talk more carefully to each other, but they didn't change the underlying structure of how IMF surveillance is conducted, so there's still 4 separate reports.
So you would think that by looking at all these different angles, the IMF must have been pretty good at what it's doing in terms of surveillance. Do you think that the setup and the work that went into it was effective?
Well, the answer to that is yes and no. Let me start by saying how I assess the effectiveness of fund surveillance. So I look at the advice being given since mid-2001. And why do I do that? Well, there are 3 reasons for that. The first is that there were 2 large non-economic shocks which had global effects on the world economy. And those were the COVID pandemic, including the response to it, such as the lockdowns in China. And the second was the Ukraine war. Now, it may sound a bit funny to call the Ukraine war a global shock, but from the economic point of view, the main impact of the Ukraine war was its impact on commodity price, in particular oil, because Russia is a big oil producer, and then cereals, because Ukraine's a big cereal producer. And a bit like another regional conflict, 50 years ago now, Yom Kippur, where again, the conflict was local, but it created the first oil price hike, when oil prices quadrupled. And so that's, and the point about this is that because there were global shocks, the IMF is particularly well designed to analyze them. The second reason is, as we know from the conversations around here over this week, there have been some significant consequences. The first, of course, has been the big rise in inflation. So obviously something went wrong because we ended up with much more inflation than anybody expected. And in addition to that, because in reaction to that unexpected inflation, monetary policy was tightened very fast, we had a series of bank failures. 3 medium-sized American banks and 1 major European investment bank all had to be rescued. So we had these consequences. So the final point is, why mid-2001? Why not the beginning of the COVID pandemic? Well, I think we would all acknowledge that the beginning, that COVID itself was one of a kind. I mean, the last major pandemic we had globally was influenza in 1918, so it's been a long time. So to start at the beginning of the COVID pandemic, when everything was so uncertain, I think would have been unfair. But by mid-2001, people were realizing the world would recover. We had vaccines, we'd experienced lockdowns, and so that's why I started in mid-2021, because I think by that time we had a good idea about the impact of COVID on the global economy.
So, okay, so what you've been saying is that you're using that period to assess the effectiveness of surveillance,
yes,
as you just let out the reasons for it. Now, we're in the middle of that COVID crisis, and what do you think? How did the IMF do in its assessment?
Well, the answer is mixed, and it is certainly true that the IMF identified the potential risks which in the end came to occur. So, for example, as early as the beginning of my sample, the IMF was already warning that there was a risk of high inflation and that inflation becoming persistent and getting into the system. And the Global Financial Stability Report from the beginning of 2022 worried that a rapid rise in interest rates of the major central banks, monetary tightening, could create financial instability. So they identified the risk, but the policy advice was a lot less impressive. Essentially, on inflation, through early 2022, the World Economic Outlook continued to say inflation will be temporary, don't raise interest rates because it might hurt the recovery. Okay, so they said, don't raise interest rates, keep the recovery going, and as they say, in the long run, this turned out to be bad advice because we ended up with much more inflation than anybody had anticipated. And partly as a result of that late start, we ended up with a very, very fast tightening of monetary policy, and that created the financial problems. Now again, the Global Financial Stability Report had been warning about financial instability, but it focused on the risk to emerging markets and to the peripheral parts of the financial system in advanced countries. But actually, the problems came in the core banking system. And the GFSR had gone out of its way in October 2022 to say actually that the core banking system was pretty sound. So again, the policy advice was to focus on the wrong parts of the financial system, and where the problems actually occurred was in the core of the banking system, which the GFSR had said was pretty sound.
Now, you could of course, or one could of course say that, well, the IMF is not a banking regulator, there are many other institutions that are supposed to look at it. So are we singling out the IMF for criticism here when you say they could have done better in terms of the policy advice?
Well, look, a lot of people missed what's going on. But I'd say there are three reasons to think that the IMF was in a good position to analyze this accurately. The first is it has near universal membership, and it has a very wide range of skills. It has people who know about financial issues, people who know about macroeconomics, people who know about external issues, and people who know about fiscal issues. So it's got a very broad membership and wide range. Plus, as I said earlier, these are global shocks. So you would have thought that an organization like the fund would be particularly well suited. And so I think that for those two reasons, there are reasonable reasons to think that the IMF was in a particularly good position to identify these risks and provide the policy advice to move us beyond them.
Well, I mean, okay, so inflation is coming down now, no other banks have failed, so is there a cost to this? What is the harm of the IMF missing kind of such a development?
Well, if you've been around here, everybody's still talking about lowering inflation. If you look at the World Economic Outlook, they're not predicting that inflation will come back to central banks' targets till 2025. So, and the big question is, can we bring down inflation without a big recession? So it seems to me there are real costs to these mistakes on that side. And on the other side, on the banking side, these banks failed. Luckily, no other banks have failed, but bank lending is being constrained, and that affects the entire economy, and in particular, small companies who are particularly dependent on banks. So it seems to me that there are real consequences to these miscalculations. Macroeconomic stability has been undermined, and so, frankly, has the credibility of some central banks. And that seems to me to be something which everybody got wrong, but the IMF, given its resources and its perspective, should have been a leader, not a follower.
Right. No, I mean, the IMF is, of course, charged to ensure global financial stability, both through surveillance and lending. So I understand that you're saying it's really got global consequences, so it is something for the IMF to watch out for. Now, having established that there's a mixed track record, as you say, how do we improve IMF global surveillance? What should be done to make it work better?
Well, the defenders of the current system say that actually the IMF has one message and it's simply sending those messages to different audiences. So the World Economic Outlook speaks to macroeconomists, the Global Financial Stability Report talks to financial economists, etc. But if that is true, then one point about that is that that means that there's an awful lot of resources going into producing different versions of the same story. And so one slightly less important issue, I think, but still important, is the amount of resources. Those resources could be used doing something else. If you had a single report, you could spend more time actually thinking and analyzing. The second and much more important point, I think, is that it's very difficult to believe that these groups all think identically. Certainly they talk to each other, and we all know that. There's lots of cross-references in these documents. But surely the point about having different publications is that they come with a different perspective. But it seems odd in an organization which has so many different skills that you don't try and meld them and bring them together. So because of those reasons, my suggestion is that rather than having 4 long reports, what we can do is we can have a single report which outlines the IMF's view of the world economy, its risks, and the policy advice, and really focuses in on the policy advice and how we avoid what might happen.
So if I understand you right, is that there could of course be bureaucratic arguments, like you have less resources to produce fewer reports, it's more efficient, it's also easier on the reader, I guess. But I think your main argument is that by forcing these different strands of work into one report, you actually force some integration of views that may not otherwise happen.
Yes, and let me give you a couple of examples. The most important, I think, was when they started tightening monetary policy, the central banks, after inflation got out of control, one of the things they ended was something called quantitative easing. This was where central banks bought bonds in order to lower long-term interest rates. Now, as they started to tighten monetary policy, they of course ended this policy and reversed it. Now, if the policy itself was lowering long rates, then the reverse of the policy would raise long rates. And that, of course, means bond prices come down, because that's the way long-term interest rates work. And there were a lot of financial losses in there. Now, what's striking is, if you look at the Global Financial Stability Report over this period, they certainly talked about the risks of monetary tightening. But they didn't point out that because of this policy of quantitative easing, there was likely to be a particularly large rise in long rates compared to the typical, and that could have large losses. And what's important about this is it was actually the losses on these bonds which felled the 3 US regional banks. So, I mean, this had real consequences. And the fact that the Global Financial Stability Report, while worrying about about stability, obviously, didn't focus in on these losses, which were coming from a macroeconomic policy, seems to me to sort of illustrate how the macro and the financial don't always meld particularly well in the fund. Let me give you another slightly more minor example. Yesterday, both the World Economic Outlook and the Global Financial Stability Report were presented. And the World Economic Outlook was mainly about prospects for a soft landing, as it's called when the global economy doesn't have a recession. While the Global Financial Stability Report spent a long time worrying about the recent hike in long-term interest rates. And not only me, but a lot of people I've talked to sort of said, well, you know, what is the story here? And it strikes me that that's another example of where if you have 4 different publications, it's pretty difficult to completely connect the dots. It would be much easier to connect the dots if you had one place where everybody had to agree on something.
But you're not only saying also that one should put these 4 reports together, and one, you also say that the one report that we would then have should be really short and focused. What's kind of the point here? Isn't it better to kind of sometimes explain in depth what's going on in the world economy?
Well, if you remember, when I described these reports, I said that they were a mixture of 2 things. The first is an assessment of the current conjuncture and its risks and the policy advice, and then a series of chapters showing research. One of the interesting things about reading these reports is that it's not clear that having research in-house, actually in the group, is always beneficial. And I'll give you an example. Perspicaciously, the World Economic Outlook in October 2021 actually had an entire chapter on experiences of inflation and bursts in inflation, exactly what happened. But the chapter said basically, the analysis implied that as long as inflation expectations remained anchored around the targets of the central banks, there wasn't a lot to worry about. And of course, what happened in actual fact was that its expectations did remain anchored, but inflation itself went out of control. So here we have an example of somewhere where the policy advice seems to have been at least partly affected by their own analysis. I'm not against using research in forecasting or in policy advice. I think it's absolutely essential. But I think you can be too close. And so that's one reason. Another reason I think that having research actually in-house may be a bit of a worry is, obviously, you should know about the past and you should understand the patterns of the past, and that's absolutely essential. And that's what research does. But you also have to understand the oddities of the present and the specifics of the present. And for example, one of the oddities of the COVID recession was that an awful lot of people resigned their jobs. It's called the Great Resignation. And so there's a lot of vacancies. And as a result, there were many more vacancies than you would normally have expected given the level of unemployment. Now, if you only look at the conventional measure, the level of unemployment, you'd get too small an assessment of what the real pressures were in the labour market, because there were so many vacancies. A lot of employers were going out and looking for people. So 2 respected economists have argued that this is basically why inflation rose so much, which is that people underestimated how tight the labour market was. And here again is somewhere where, looking at the oddities of current situation is equally important as looking at what the history is from the past. And it strikes me that that's easier to do if you have a publication which is only looking at the forecasts, the risks, and the policy advice. And I think it also allows you to really focus on the policy advice, which is really, as I say, where the publications seem to have done less well, and think, well, really, what do we need to do in this situation?
So a more actionable report in a sense, right?
Yes.
Now, the IMF kind of prides itself of being a very lean bureaucracy, but it's still a bureaucracy, as we both know. So what do you think? Is it going to be easy to kind of make that transition to one single short focused report if there was a decision to do that?
No, I think it won't be easy. As you say, it's a bureaucracy, and bureaucracies have fiefdoms, and there are fiefdoms around all of these reports. It will certainly take an effort from management, and I think quite an strong effort from management to do this. But I think the gains are very important. One of the unique features of the International Monetary Fund is that it is, as I say, an institution which both has a near universal membership and all these different expertise. Now, if you're looking at it from the outside, what would you expect such an organization to do? You'd expect it to take a global view, which it does, and you expect it to integrate all those views into a single idea. having all these silos where you have some people doing macro, some people doing finance, some people doing fiscal, some people doing external, strikes me as moving against the strength of the organization. Say to have all these different people in one place, you want to meld them and discover what you can say about the world. Mm-hmm. Instead of which, it's all become slightly sort of bureaucratically convenient. Oh, I'm the fiscal guy, I'm the macro guy. So the central thing, I think that the membership and the world should expect from the IMF something where they actually meld all of this and bring it together. And I think that's what the IMF owes to the rest of the world.
Too many reports. Food for thought from Tamim Bayoumi. Thank you very much for presenting your work. And we will come back to the World Economic Outlook and the GFSR a little bit later today when we have an in-depth discussion of yesterday's release. Thank you very much.